One vote, taken on July 29, decided how the market would read a jobs report that had not even been printed yet. 9 days later, the S&P 500 closed at a record 7,757 on the ugliest payroll number of the year. In the same 5 sessions, gold ran 7% and silver ran 10%. Stocks at highs and metals on fire do not normally share a calendar. I will tell you exactly what that vote was and who broke ranks, but the setup comes first, because the loud story this week was the wrong one.
The misdirection was convincing. On Tuesday, on SpaceX's first earnings call as a public company, Elon Musk said SpaceX will build data centers on the ground and in orbit exclusively on Nvidia silicon, using the Vera Rubin NVL72 racks.
Nvidia finished the week up more than 10%.
The Philadelphia Semiconductor Index rose over 8% in 5 sessions. Great headline. It explains one sector's bounce.
It does not explain a record index. Over the past 12 months, AMD is up about 180% while Nvidia is up 28%. The chip leadership already changed hands, and most people narrating this market haven't noticed.
Here's the other thing that story leaves out.
On Thursday, a report landed saying Nvidia is testing Rubin Ultra with a fraction of the memory it originally planned, roughly 200 gigabytes of high-bandwidth memory against a 1 terabyte target. The stock went up anyway.
Here's the part that actually set Monday up. Friday morning, the July jobs report showed the American economy lost 23,000 payrolls.
Economists were looking for a gain of about 80,000.
That's 100,000 job miss in one line.
Then revisions pulled another 103,000 out of May and June combined. The second quarter's labor market was materially weaker than anyone was trading on a month ago.
Now the strange part. Unemployment didn't rise, it ticked down to 4.1%, below the 4.2 forecast. Why?
The participation rate slipped to 61.4.
Fewer people counted as looking.
Wages cooled the same way. Average hourly earnings rose 0.1% on the month, 3.2% on the year, against 3.5% expected.
Cooling labor cost, not collapsing demand.
This cycle's fear is not a missed rate cut.
It's a rate hike.
That's why a bad jobs number lit a fire under stocks. The Fed is held at 3.5 to 3.75% for 5 straight meetings, with inflation still running above target.
Going into Friday morning, futures put September hike odds above 57%.
By the close, they were at 42%.
The bond market said the same thing, more precisely. The 10-year yield ended Friday at 4.66%, down about 9 basis points on the week.
The 2-year finished at 4.20, down almost exactly the same. Both ends falling together by the same amount isn't a growth scare, it's the whole rate path shifting down in parallel. And here's where it gets genuinely strange. In the same week the S&P hit a record, gold rose 7% to about $4,400 an ounce, and silver jumped 10% to $63.50. Records in stocks and a violent bid for metals do not normally happen in the same 5 sessions.
That combination isn't risk-off.
It's a market buying the rate relief with one hand and hedging the credibility of the institution delivering it with the other. Utilities, real estate and home builders led to everything that hates high rates.
Now look at what chips just did.
In July, semiconductors fell about 15%, and a single late July sell-off erased more than $1 trillion of chip sector value globally.
This week, the same names rallied 8% in 5 days. No new earnings from Nvidia. No new guidance.
The fundamental picture was identical on Friday to what it was 10 days earlier.
The single stock tape was just as emotional. Palantir jumped 29% after Monday's report, its best day since February 2024.
AMD fell 8% on results that beat, then clawed back to finish the week up about 2%. Alphabet guided 2026 capital spending to $195 to $205 billion, and got sold for it.
The market is not pricing facts. It's pricing mood about facts. And the cushion is thin.
The VIX closed Friday at 14.9 under 15, 2 weeks after a $1 trillion drawdown in the sector that carries this index. The S&P trades near 20 times forward earnings, against a 10-year average around 19.
That's not a bubble reading.
It's also not a valuation with room to absorb a bad inflation print.
Cheap volatility plus full valuation is how small surprises get expensive. Here's the split almost nobody is talking about.
JPMorgan's wealth strategists now expect a quarter-point hike in September, after previously forecasting no moves at all in 2026.
Futures say the opposite, a 42% chance, a coin flip that leans no.
The crowd in one of the largest houses on the street are on opposite sides of the same meeting.
One of them repositions. So where does the pressure actually land? Wednesday, 8:30 in the morning Eastern. July CPI.
That single release carries more weight for Monday's tape than anything Nvidia will say 3 weeks later. June's headline came in at 3.5% year over year, core at 2.6.
The headline fell mostly because energy fell. Core is what the Fed watches, and core has been the sticky one. Which is why oil matters more than usual right now. West Texas settled near $78, Brent near $83.50, with the Strait of Hormuz still normalizing slower than anyone modeled. JPMorgan's framing, oil up toward 120 is manageable for the US economy, and the recessionary case needs 140 plus alongside a sharp equity drop. Energy was one of the few sectors that fell this week. Watch whether that holds.
And then there's the man who sets the price of money. Kevin Warsh took over the Fed this year, and at his July press conference he said this, quote, "There is no soft inflation target, no soft implicit target, not on this committee's watch, there's only a target, and it's 2%. That is not a chairman hunting for a reason to ease. 3 of his own colleagues wanted to hike immediately. So here's the working checklist for Monday.
First, watch the 2-year yield, not the headlines.
It closed at 4.20.
If it drifts back above 430 before Wednesday, the market is quietly putting the September hike back on. Second, watch breadth.
Friday's leadership was utilities, real estate, home builders, and the Russell 2000 rate sensitives, not just chips.
If Monday is semis alone again, the record is narrower than it looks. Third, watch gold.
If metals keep bidding while stocks rise, the market is telling you it doesn't fully trust the disinflation it just celebrated. Fourth, the dollar. The index closed at 99.56, and the euro hit 7-week highs.
A weaker dollar into a hot inflation print is the uncomfortable combination.
And Nvidia's number, on August 26, gets graded against whatever rate path Wednesday sets. Now the decision I promised.
On July 29, Warsh's Fed voted 9-3 to hold, and all 3 dissenters, Beth Hammack, Neil Kashkari, and Lori Logan, voted to raise.
It was the first time since September 2016 that 3 officials dissented in the same direction, and the earliest revolt against a new chair since 1970. That vote is why a minus 23,000 payroll number was worth 3.6% on the S&P. It didn't buy a cut, it bought the removal of a hike.
Monday doesn't hinge on a chip. It hinges on whether Wednesday lets that hike back in the room.
That's the story. If you'd watch one more like this, hit subscribe and I'll have another ready soon.